All right. So we do have, for those of you that are new or may not know who he is, we have Mark Willis with us today. He is a certified financial planner, a two-time #1 best-selling author, and the owner of Lake Growth Financial Services, which is a financial firm in Chicago, Illinois. Over the years, he has helped hundreds of his clients take back control of their financial future, built their businesses with sophisticated, tax-efficient financial solutions. Mark also co-authored the best-selling book, How to Be an Amazon Legend and Fire Your Banker. If anybody here has that book, as I know, yep, we got a handful of you guys, with the legend himself, Danny Stock, right here. So Mark specializes in building specific, little-known financial strategies, custom designed for online sellers like you guys. He's also the co-host of Not Your Average Financial Podcast, and he shares some of his strategies for investing in real estate, saving and paying for college without going broke. That's good information. And creating an income in retirement you can't outlive. Mark works with people who want to grow their wealth in ways that are safe and predictable, become their own source of financing, create tax-free income in retirement. Guys, let's give a warm welcome to Mark Willis.
Appreciate it. Thank you, thank you. Do I need this one too? Oh, okay. Good morning, everybody. So glad. This is like a highlight of my year to get to be with you all and to see you all. So thank you for making the long travels to be here today. Do we have a record on how many miles? Who believes they came from the farthest destination? Okay, okay. Sue, California, I think, right? Okay, and then anyone go farther from California? Diego. All right, Diego. I know where you're from. Great. Switzerland, yeah. All over the world, basically, right? Awesome. Great to see you. Okay. Well, let's get right into it. So again, happy to be with you all today. We're going to cover a lot of ground and think through some things, but I want to make sure, does everyone have a folder on their table and a pen and a couple of marshmallows? Marshmallows? No, if you do not have a folder, raise your hand and we'll get you one. We'll get you one. Go ahead and keep the hands raised just for 1 minute if you don't mind, and we'll come around as fast as we can. So I'm very happy to be with you all today. I want to talk about why there's a big pile of marshmallows on the table. Let's get the white elephant out of the room, let's say. So has anyone ever heard of the marshmallow test? No? Let me kind of describe this for you, and if I can, I don't know if I can even do this, but so there's essentially a Stanford experiment that was put on in 1970, long time ago, and it was the very first marshmallow test that was conducted. Basically, the purpose of the original study was to understand when the control of delayed gratification sets in. All right, so imagine a little boy, and you can see the picture of him there, is seated down at a table with one marshmallow on a plate, and the instructor tells the little boy, okay, little boy, if you stay here for 5 minutes and don't eat this marshmallow, I'll come back and I'll give you another marshmallow. But if you eat that marshmallow, I don't give you the second marshmallow. Okay, so you can imagine what happened. This is kind of some pictures of this little boy, you know, unprompted, some of his own facial expressions while he waits that notoriously long 5 minutes. And they did this with one boy, but actually a lot of students went through this. And what really shocked the folks who were doing the study was they tracked the children after the study. So the power of this study is not the event itself. You can do this with our kids at home. In fact, I'm planning on it. Don't tell my daughter, but she's going to be getting the marshmallow when we get back home. Because the little kids that were able to wait that 5 minutes and got that second marshmallow, they actually performed better throughout their lifetime. They had higher SAT scores, 210 points. They had higher confidence, concentration, reliability. They had fewer divorces. They had more successful businesses. They had a higher net worth, all because of a marshmallow. It actually is a more correlated description of success than the IQ test that the same kids took. So that little marshmallow means a lot. And don't worry, I'm not testing anybody in the room. Feel free to eat those marshmallows. I promise. We're not doing any experiments here today, I promise. They're safe. But it proves a point, you know. Do you want to make decisions with short-term pleasure but long-term pain? You want to have short-term gains or long-term gains. And so, you know, we could talk about this in all areas of our life. You know, we could talk about how we need to skip that cupcake for the healthy heart or the BMI, or the great BMI. You know, we could talk about when we buy real estate. There's closing costs on real estate. There's fluctuations in the market. Obviously, usually the day after you buy your home, there's a couple of things to fix up, you know, on day one. You could talk about our Amazon businesses, right? There's no free business out there to get started, even though if it's a low barrier to entry, there's inventory to buy. And there's the delay between purchasing that inventory and seeing a reward at the other end, you know? But we all know as adults now that, you know, having a cost is possibly worth it if the reward exceeds the cost. Nice and easy, right? The equations are going to be pretty easy this morning. If the cost is less than the reward, it's usually worth the price for admission. So how does this play out on a nation? How does the marshmallow test apply to the American economy? I've done some studies and research on this, and apparently a lot of our fellow Americans are eating that marshmallow. Okay, so 47% of American households have less than $400 in cash, like in a savings account, checking account, or on hand. Less than $400. That means every other person that you meet on the street has less than $400 in liquid accounts. That's according to a Federal Reserve study in 2015. And they've redone the study this year, and the study stats haven't changed. 31%, or nearly 1/3 of people who are not yet retired, have no retirement savings at all. And 27% of those people are over 60 years old. Let that sink in for a minute. Millennials are 40% more likely not to have any retirement savings than Gen Xers, and 50% more likely than people age 55 and older. So there was a recent study done that, and I'll pull it up here, Edward Jones survey in 2014 says that we spend more time planning our vacations than planning our own retirement. If that's not a marshmallow test, I don't know what is, right? 28% of Americans have more credit card debt than they have savings. That's a big deal. That's a big deal. And this is apparently at the end of an 11-year bull market. When the stock market's up and savings rates should be coming up, we're spending more on credit cards than ever before. Americans have more debt now than they did at the end of the height of the Great Recession, according to Federal Reserve Bank of New York. 35% of the average income goes toward debt. 35%. So if you make $100 on Amazon today, if you're the average American, I think you guys are not average around here, but if you were the average American, you'd be spending 35 cents on financing, the servicing of the debt on $100. So, and I laid it all out here. On the average, the family debt across this country is $136,000. That's not including what the government says that we would all owe as citizens if we need to pay off our national debt. This is household debt only. So any type of debt on the average is $136,000, or $13.86 trillion. That's $138,000 billion in total debt. Now, of that, you can kind of break it all down: credit card, revolving credit card debt, mortgage debt, auto loans, and student loans on the average. So if these numbers are not your numbers, if you're better than the average, first of all, congratulations, you can have that second marshmallow. But it also means someone else is twice as bad to make this the average, right? So that's huge. I mean, incomes are growing, but many costs are growing faster. And I believe that's part of the reason why we're seeing these trend lines going this way. So let's talk about debt for a minute. A lot of people, and a lot of people I work with on an individual basis, will tell me that they have low interest credit card debt. and their mortgage is 4%, and their auto loan is 2%, and their boat loan is 4%, and their vacation home is 6% interest. We have such low interest rates, and yet we have so much debt. So what's going on there? How is that possible? Well, think about it. If you went to the doctor and the doctor said, well, we need to give you an injection. You're sick. We need to give you an injection to protect you and help you recover. And, I don't really know how fast or slow I'm going to send this injection into your arm, but I've got 10 gallons of the injection to put into your body today. Would that worry you at all? Okay. So it's not the rate at which you're given that injection, it's the volume that counts. It's not the rate, it's the volume that counts. You could have a 4% mortgage, a 6% student loan, 4% car loan, and so forth, even zero interest credit card debt, but if the weighted average of your total debt might be 8%, let's say, but yet you might be spending, in this case, 38% of your income. I had a gentleman one time, he was so proud of making $250,000 a year, medical professional. He was very happy with his rate of return in his stock market portfolio, and yet he was spending $80,000 a year on servicing his interest. Just 80 grand on just servicing the nut of his debt. That's a third of his income, if you do the math there, even though most of his debt was low interest. We're living in a very weird time right now as an economy. We have very low interest rates and very high amounts of debt. That doesn't always end well, I'll just say it. So what is the problem? The ultimate problem is, I believe, we're not thinking long range. We've got that one marshmallow in front of us. So how does this work in the Amazon selling space? And how does this work in your lives and in your businesses? Well, there's probably a lot of applications to the marshmallow test here, but one thing I hear a lot is that we've got to prepare for this year's Q4. We've got a big push of inventory and a lot of work that needs to go into buying a lot of our inventory. How can we get off that cycle? It kind of looks like a cycle, doesn't it? You're always running sort of to keep up with the next quarter's inventory purchases. How do we get off that? Or even, especially if you're going into debt financing your inventory. And how do we do better even than just paying cash? How do we do better than just paying cash for our inventory or our staff or our other services that we need to cover for our business? We have to think, I believe, we have to think different. We have to think like an airplane pilot thinks. Does anybody in the room fly an airplane or have a pilot's license? Okay, will you be taking us out on a flight later today? Because that'd be so cool, so fun. All right, so let's talk about it. Let's say airplanes, of course, don't fly in a vacuum. They're flying in an environment, right? When the airplane lifts off, it has to, of course, fly through the environment that it's in. So imagine you're piloting an airplane that maybe it can spin its motor and get you on a ground speed of 100 miles an hour, if there's nil wind. Okay, if you could go 100 miles an hour in this airplane, and you want to go from, New Harmony, Indiana to Chicago, you could get there in a few hours, I guess, right? If there was no wind. But now let's imagine something like this scenario where you have a headwind coming at you. And let's just pretend it's a crazy 345 mile an hour headwind coming right in your face. Even as hard as you push, as hard as you might try and want to get to Chicago, you're going to be heading toward, Alabama and out into the Gulf, right? That's the direction you're headed. Doesn't matter what your plane is going to try to do. So you have to do something different. You have to land that plane, right? You can't do much about the environment except to land that plane and wait for the wind to change. And it always changes. So you have to wait for that wind to change. Once the wind dies down and there's no headwind, now you can get back up in the air and start flying towards Chicago, and you'll be eating deep dish pizza by dinner time. All right, so this is where most people stop in their financial lives. When they think they're doing as best as they can do. I call this the arrival syndrome. This is where, our plane can run 100 miles an hour. And gosh darn it, I'm going to try to get that plane to go 103 miles an hour this year. I'm going to rev that engine, and I'm going to put more into risky stocks, and I'm going to put more into risky assets, and I'm going to put more into my riskier and speculative side of my portfolio, or try to put more into things that I don't understand. That's the traditional financial system, that we pay cash for everything and try to get a little bit better rate of return. And I'd say that's fine, and that you should try to do that. But be aware that that engine was never designed to go more than 100 miles an hour. And the more you push, the more you're possibly putting yourself in danger, right? See, for example, 2008 in real estate, okay? So that's what I see when I talk with folks quite often. But this is really not the best that we can do with our money, is it? The airplane can do a lot better than 100 miles an hour, a lot better. How do we get it to work even better than the airplane could ever fly? You wait for a tailwind. Most people think that they're looking around and they're seeing everybody else doing the right things to do with money. But if you can really let the tailwind get behind you, now you can shoot toward the great city of Chicago in half an hour. If you have a tailwind of 345 miles an hour, plus your airplane is going 100, now we're doing 445, right? 445 miles per hour. That's awesome. You split that between the headwind and the tailwind, and your delta, the difference in speed, is almost 700 miles an hour. Let that sink in. That's the power of creating and controlling the environment that your money lives in. Remember, airplanes don't fly in a vacuum, but if you can control the environment that your airplane is flying in, you're going to win. If everyone else is just flying at 100 miles an hour, or worse, they're going backwards, and you're running your plane at a delta speed of 690, you're going to beat the competitors on Amazon or anywhere else, and most importantly, have a peaceful financial life. So what do? You fill up your gas tank, right? You wait, you save, you get ready, you wait for that second marshmallow. There's a quote that Gloria Steinem says, "Rich people plan for 3 generations, and poor people plan for Saturday night." Okay, I looked this up. This is kind of cool. The oldest family-owned business. How many businesses here would you say are family-owned? I bet you almost all of them, Almost all of you guys are personally the owner of the business that you run, right? How many would like to see their family or even children possibly get involved somehow in the business someday? Yeah. Talk to Scott Moody about the Family Prosperity Index. Raise your hand, Scott. Talk to Scott about this. He's got some really cool ideas and data to back it up on the Family Prosperity Index. So chat with him about that. But I looked this up. The oldest still running family business is out in Japan. It's a really cool old hotel, and I'm not even going to try to say the name. Ryokan, I guess? Hoshi Ryokan. It's a hotel that started its business. The founder started it in 700 AD. It's still going. You can go stay there tonight if you get on that cool airplane that can do 400 miles an hour. But it's in its 46th generation, still in the family. How cool is that? That's a guy who's thinking long range, right? He starts that business. Do you think he was thinking about short term, what's this quarter's results going to be? No. Most Wall Street returns are all focused on the earnings reports of this quarter, But he's thinking about 46 generations, this guy who founded that hotel, right? Isn't that cool? So time is money. We can't get over that fact. Time is money. So my question as a financial planner is, when do you want that money to be working at its best? Have you ever thought about that? The best time to have your money growing as fast as possible is when you don't have an income in the future. Income stops. Expenses never stop as long as we live. But income will stop for all of us, for me, everybody, all of us, which is why passive income, and 16 streams sounds just right to me, Ryan, is the best way to get it done. And you want more income in the future to deal with inflation, increasing costs. So I want my money getting more and more efficient every single year. What if my airplane could go faster and faster every mile it flew? That's the way I'd like to fly my plane. In fact, that's how an airplane does fly. Have you ever thought about that? You don't get in an airplane to go to the grocery store. You get in a car to go to a grocery store. The airplane is very inefficient for the first few miles that you're flying. It's got to overcome inertia, gravity, the wind, everything. But no one would drive, except for me, I guess, from Chicago to New Harmony. You get in an airplane, right? Or from New Harmony to LA. You get in an airplane because it's more efficient over the long haul. And every mile that airplane flies, it's overcoming inertia, and there's less gas in the tank, so it weighs less. It's becoming more and more efficient every single mile it flies. How cool would it be if your money could do the same thing? Just a heads up, I think my Zoom is reconnecting over here. I don't know if that's good or bad, but not good. Okay. Oh, here we go. Okay. Share. Got it. You bet. There we go. I think we're back on. Cool. Great, guys. Thank you. Okay, so let's talk about inefficiencies and efficiencies. Okay, so Wall Street on average has lost, get this floored me when I figured this out. And I'm classically trained as a certified financial planner. So I'm supposed to tell you the party line is invest in the stock market, forget this business stuff and get into the stock market. That would be the party line of CFPs. All right. But you look at the data on this, on the average, every single year for a century, the average loss in the market is 14%. Every year. Even if it was temporarily down and then up again, that's money that did vaporize. It's not there anymore. It's gone. And every 3 to 5 years, there's a 34% drop called a bear market on the average over the last century. So many advisors will tell you, hey, that just buy and hold. Don't look at that 401k. You hear it in the news all the time. Don't look at it. Just ignore it. It'll bounce back. Invest for the long term. I have a problem if someone's stealing a third of my money out of my pocket every 3 years, or 14% of my money every single year. I have a problem with that. If that happened on the subway in Chicago, I'd find another way to get to work. So the problem with losing 14 or even 34% every couple of years is you have to earn a lot more than those numbers to break even. Have you ever thought about that? Ever done the math on that? You have to do a lot better just to break even. If you lose 50%, which happened in the Great Recession, you have to grow your nest egg 100% just to break even with what you lost. Another type of important risk to keep an eye on is sequence of returns. Sequence of returns. If you have a financial advisor and he or she has not brought this word up, bring it up to them and see if they know what that even means. This is an important risk that most people are taking. And why am I showing this to online selling in an online selling context? It matters. Again, you want your money growing more and more efficient every single year. So take a look at this for a quick minute. I realize the numbers might be small. I am going to zoom in on a next slide here, but this is Jane and Jim. They're both 65 years old. They're both ready to start retiring now. They both have exactly $500,000 in their retirement account, and they both are going to get the exact same rate of return over the next 13 years. They're also going to take the exact same amount of income out of their portfolio to pay for groceries and so forth in their retirement. So everything sounds perfect so far. Can anyone just kind of shout out, do you see anything different at the bottom of the screen? Who has more money, Jane or Jim? Jim, okay. Sorry, Jane, but why is that? We have the exact same numbers all the way down, the exact same rate of return. What surprises most people is that Jane had early negative returns in her portfolio. So at age 81, she only had $74,000 left in her portfolio. How do you think she feels at this point? She nervous? I mean, how would you feel, right? So Jim, on the other hand, still has $344,000 left in his portfolio. How is that possible? It's the order in which they got their return. One of them got negative returns. Poor Jane got negative returns early on in her retirement years, while Jim had some positive returns. We just flipped the returns upside down. I don't know if you can tell that. All we did was we just flipped the order of the returns, the exact same average return. That's why I don't believe in average rates of return. They're meaningless. It's what matters is the order by which you're getting those returns. And it's especially crucial as you're nearing retirement to make sure you don't lose any money you already have. Because if you're pulling money out of an account that lost money in the market this year, that's called double pain, right? Okay, so they have control over how much they take out as income, but they have no control over what their rate of return is going to be in the market. So let's go on. Let's talk about the inefficiency of volatility. Boy, that's a mouthful. And we just kind of got done talking about that, right? It's inefficient to have volatility. Okay, has anyone ever heard the phrase, as the crow flies? Is that a Hoosier term? I grew up in Indiana, so Maybe it's me. As the crow flies. That's like, you know, how far away do you live? Well, about 13 miles away as the crow flies. Well, what does that mean? That might mean I live 100 miles through a dense wooded jungle, you know, by road, but only 13 miles as the crow flies. So which one might take more gas, more time, more energy to get to? Well, you know, it's sort of like this picture on the screen here. The crow is flying from Billings, Montana to Chicago in a straight line, but the volatility of the highway system would mean you'd have to drive a much further distance, right? Imagine if you had to drive, if you had to drive from here back to your home in California, it would be a much further distance if you had to go through side streets and back, you know, if the highway system wasn't set up. So how does this work with if you go up 100% in one year and down 50% in the second year, that says your investment advisor could tell you have a 25% average rate of return. You should be feeling great. Your 401k statement might say 10% year to date average return. But the truth is you might be out of money or less money. You know, if you go up 100% from $100, that's $200. If you lose half of $200, you're back down to your original $100. That's a 0% real rate of return. Okay? So like a fish out of water, if you put your money in the wrong spot, it's gonna flop around and die, right? So where you put your money makes it really do different things. A fish will thrive and even reproduce in the right environment. So we're back to talking about an environment, right? Airplanes need an environment to fly. Fish need an environment to swim and reproduce. Your money needs the right environment for it to thrive. So what are some of the common financial environments you can keep your money in? Well, we got them on the screen there. You know, 401ks, IRAs, brokerage accounts, banks, credit cards, finance companies, real estate, inventory in your Amazon business, or just a safe or a shoebox. So what if you could see your money grow at a faster and faster and faster rate and a larger and larger and larger amount every single year, no matter what? What if you could keep your money available for your business? What if you had a plan not just for this Q4, but the next Q4, or the next Q4, and the next Q4, and 46 generations later of Q4s? What if you had a plan that could do all that? What if you owned and controlled the outcome of your money before you even started? What if you owned and controlled the outcome of your money before you even started? So what's the right environment for you to keep all of your Amazon profits? You know, there's lots of places you can put it. And believe me, as a CFP, I had to study all this just to get those letters after my name. They throw you into about 3.5, 4 years of training. At least that's how long it took me. Maybe I'm just slow. But it took a long time to explore dynastic trusts, you know, raw land, you know, brokerage accounts, stops and puts, options trading, day trading, online businesses included. What's the right environment for your money to live? to help your business grow and thrive and reproduce and last for not just this year, but for 46 generations. I'm fully convinced at this point it's high cash value, dividend paying whole life insurance of all things. This is a random side part of the financial universe that they don't really spend a lot of time talking about. In my CFP studies, certainly not on CNBC, but I believe, and I hope you'll agree by the end of our talk here, that this is a great spot to let your money live, grow, and crucially become more and more and more efficient every year you have it. So this is not the kind of whole life insurance that you've heard about on the radio by Dave Ramsey or Susie Orman, all right? This is very categorically different. It's supercharged with additional riders on the policy, options that make this policy grow much more efficiently. So it absolutely gives us roughly 40 times more cash value in the first year. And the commissions, crucially to the advisor who sets one of these up for you, they have to be willing to take a 50 to 70% pay cut just to design the policy properly. So that's maybe partly why you've not heard about this before, right? Okay, so you have to be working with an advisor who has your interest at the top of their list. So, why dividend paying whole life insurance? Why couldn't I just do a savings account or something else, right? Well, whole life insurance has increased in value every single year for over 160 years. Even when the stock market was crashing, 1987, 1929, 2008, it was producing guaranteed growth and additional profits on top of that. It beats other savings and cash equivalents, so your CDs, your money market accounts, your savings bonds, that sort of thing. It earns 5 times more than CDs and money market accounts are earning currently, but it's more liquid than a CD is, meaning you can get access to that money quickly. In fact, you can usually get the money out in about 5 days, 5 business days. Okay, so if you know that you have some inventory to buy a week in advance, you get the money out and it's yours. And you spend it just like you would if you were paying cash. Maybe most importantly, it allows you to become your own source of financing. Why is that important? Well, if Amazon Lending or Lendability or any Chase card or any Bank of America card is willing to be the bank for you, why not bank on yourself instead? Why not recapture that money, recapture that interest, and be the bank that you can pay that 35% of our income to, rather than it going to somebody else's bank? Let's make the smallest hinge swing the biggest door in your portfolio, right? So ultimately, you can accumulate wealth and give more than you could ever save for your family because it is life insurance after all. So talk about another multi-generational, long-term thinking kind of strategy. Okay, so this is also modernized for the online business world. Again, it's modernized with massive supercharged cash values, 40 times more cash than you would have had in an old-fashioned whole life insurance that you might have seen Dave Ramsey talk about or heard about on the radio or had from your parents maybe. This paid up editions rider pays no commissions, as we talked about. It's also coming, this contract is coming not from a publicly traded insurance company, but rather it's a mutually owned, like a co-op company, insurance company. So you've got to have the right company with the right contract. So you want your money doing 2 things for you at once, right? I need my money working as hard for me as I'm working for it. You want to have your money doing at least 2 jobs. I want it growing in my policy on a guaranteed basis, and I want to have access to that money to use for my online inventory needs or other business needs that I have. So that's double duty. So let's talk for a brief minute about how this policy works. Then we'll talk about how it actually, we'll see exactly how it works. I think you guys will love what we've got planned for you. So again, you can access this cash for any reason. You can control the banking function in your life. I mean, you never know what life might throw at you, right? This could be a business decision, but it could also very well be a family decision. So maybe it's a need like a car, or maybe it's a medical emergency, or maybe it's your kid's college education, or anything else. The cash value is accessible to you for any purpose. Unlike an IRA or a 401k where you have to show a hardship or there's only certain things you can use the money for, you can get the money out of your cash value life insurance, your bank on yourself policy, for any purpose. And even in the first year, you can get access to it, okay? So it gives you some peace of mind that you'll have some liquid access to your cash for even this Q4. Now, most people don't often associate loans with peace of mind. Let me explain how the loans work on these policies. So you are literally becoming, in essence, a banker to yourself. And there's a loan provision on these policies. That means you can withdraw the money if you want to, or you can borrow against your cash value and use that loan to pay cash for your inventory. Now here's where things get really interesting. And we're going to show you how this works in a few slides. When I borrow from my policy, which is growing guaranteed, and I get a loan against my policy, the policy is still here. It's still growing as if I never touched that money. And I've got this cash over here to go buy my inventory or buy my car or send my kids to college or go on vacation or whatever else I might need. So my money is doing two things at once there. So this is a way, in essence, to become an airplane flying with a tailwind, right? This, to me, is better than paying cash. How is this like or different than paying cash? Well, when I pay cash for something, that money is no longer growing in my savings account. It wasn't growing much anyway in the first place, but once I withdraw money out of a savings account, it's gone. You know, it's in the car or it's in the inventory, or it's hopefully it'll do, you know, some kind of good in the world, but it's no longer earning interest for me. When I use my policy, if I've got $100,000 in cash value and I borrow $30,000 out of that policy, it's going to still grow at $100,000 as if I'd not touched that money. And I've got my $30,000 to go buy a car or inventory or whatever else. Okay, how does that happen? They'll deduct it from my death benefit if I pass away and never repay the loan. Okay, so the insurance company knows they're going to get paid back someday, either in my life or when I get my wings. So, you know, they're going to get that 30 grand back, and they'll just deduct whatever my loan balance is whenever I pass away. I do want to pay back my loan, though, to myself. Don't steal from your own bank, right? Why? Q4 comes every year. I want to keep recycling those dollars in and out of my policy in a smart way over a reasonable period of time, so I can continue to recycle my money and use it for all the other things my family and my business needs. All right, so this is not for everybody. I want to be very clear. It's not a good fit for everyone to have one of these policies. And I don't keep all of my money in these policies, although it's the foundation and the vast majority of my own portfolio. It's where all of my safe, real money lives. But it is a nuanced, custom-designed solution for savers and investors. It is not an internally fabulous rate of return. You know, it's going to bore you to tears, especially in the early years, when you're looking at it as compared to what the stock market might, and that's the key word, might do, right? And it's also not really a good fit for folks if you're unable to save, if you can't rub two pennies together, as they say. You know, it does take saving to start one of these policies. So, you know, the ground floor of living within your means and your business having some sort of profits is essential to becoming your own source of financing. So again, when do you want your money growing at its fastest? If you want your money growing fastest right now, eat the marshmallow, I'll see you in Vegas, that's fine, no problem, no problem. It's not a good fit. Bank on yourself will bore you to tears. It does lose some purchasing power in the first 3 to 4 years. So it does take a few years before you have all of your cash that you put in there that year available to you in that year. If, on the other hand, you want your money getting more and more and more efficient, as we've been describing here today, every single year, like that airplane with the tailwind, then this is a perfect fit for where you can store your profits in between your inventory purchases. Now, if you're thinking, well, Mark's talking about life insurance, I'm definitely not insurable, I've got this and that in my history, health history, or I've got, you know, a couple extra birthday candles on the cake, so to speak, I'm a little too old for this. Absolutely not. Just know we have folks who have both of those issues or backgrounds or histories and are still owning and controlling bank on yourself type whole life policies. How? You can be the owner of a policy even if you're not necessarily the insured on the policy. So your spouse or your children or grandchildren might be the insured, whereas you might be the owner of that policy. You have all the rights as the owner that you would have otherwise. You can still use that cash for your own needs or your business. So let's talk about sports cars for a minute. How about we get out of insurance and talk about something way cooler, all right? So in creating any product that starts with engineering, whether it's an automobile or a life insurance contract, engineers are going to have to get involved. So for cars, engineers get involved. For life insurance contracts, it's actuaries that get involved. And I promise, I know it's the morning hour, so we're not going to spend much time dealing in actuarial science. I get it. That's what I do on a good Friday morning, Wednesday morning. So imagine you're driving a car that's like souped up, awesome, hugging the corners, 180 miles an hour, rockin' sports car. Now that's awesome, but now imagine one that got better and better gas mileage, went faster and faster each and every year you drove it, each and every time you turned the ignition. And what if that was guaranteed, that if the car didn't get more efficient, you could turn it in and get a new one? Guaranteed you'd have a better and more efficient car every year. Some interesting things start to happen when you look at insurance under that premise. So the insurance company guarantees that you will have a larger volume of cash this year than you had last year. Meaning, volume versus rate, right? So you're getting a bigger and bigger pool of capital guaranteed for the rest of your life. And if they happen to be profitable like they've been for the last century, without fail, you get extra profits on top of that because you co-own that insurance company. It's a mutual life insurance company. Again, you share in the profits of that life insurance company. So the question is, are you an owner where your money lives, or are you simply an asset to somebody else's bank? You know, if you put your money with a bank down the street, you are an asset on their balance sheet. If you put your money in a whole life policy that's mutually owned by the other policyholders, you co-own that asset with everybody else, like a co-op. So kind of like rings on a tree, that guaranteed cash value increase on the whole life insurance has a conservative internal rate of return. We're talking, low to middle single digits, tax-free after-tax return. So it's simple and it's straightforward and it's sort of like a savings account in that regard, but a lot better, I guess, than a savings account these days. But what really matters is the guaranteed increase on that cash every single year. Each ring might not have a great internal rate of return on this tree, but every ring has a larger and larger volume built into it. Does that make sense? So, and by the way, trees think for 1 year, or do they think long range? Oh man, you better believe they're thinking long range, right? They're thinking multiple generations. So I want to show you a picture of a guy who started a Bank on Yourself policy, but not before he tried everything else. So this is Dan Praskower. He allowed me to share this chart with you, and it shows his net worth over time. So here in the first few years, you can sort of see that he ran up with the tech bubble and then crashed in 2002. And you can see that he ran up with the real estate bubble and then crashed in 2008. And there's a little blue arrow there, and that's to represent when he started his very first Bank on Yourself policy in 2009, and a very weak recovery by that. This has been his net worth since then. Let that sink in for a minute. How would that feel? After 10 years? 10 years in the market, from 2000 to 2008, 9, and then starting your policy like this is real wealth getting locked in. Would he kibitz about like the rate of return, or would he be more impressed with the stair-step climb that he's been on ever since he started his policy? So I've been really impressed, and in fact, I plan to interview him for an upcoming podcast episode. But he is done with the Wall Street casino, right? But it's not just about rate of return and not just about net worth. Remember, this is liquid access to cash. So in addition to that limitless growth, that uninterrupted compound growth you can find in the policy, you also have money accessible via that policy loan. So that promise of accessing your cash, I think, is crucial to helping your business survive this Q4, but also next summer, maybe, when sales maybe slow down a little bit, okay? So this policy is, always available and accessible to you in that regard, whenever you need that cash. So at this point, I want to pull over for a minute, and actually I'm going to invite Amanda to come up and share with us some numbers she's crunched. These are real, actual numbers on a policy. And does this microphone also play to the online folks too? Yep, okay.
So hi, I'm Amanda. When you work with us, you might see a spreadsheet like this. Don't worry, I've got something cooler to show you in a couple slides. But this one here, breaks down what happens if you don't take loans versus if you do take loans. And let's zoom in on the one without loans. You see at year 3, there's a little over $40,000 there. And then this person's putting in $18,000 a year. By the time this person is go down here to your age 70 in 35 years, they've got $1.2 million, 1.262. Nice, awesome, saving $18,000 a year, really great, this person did that. Now, let's say they have this liquidity, they start taking money out, so at the end of 3 years, they still got $40,000, they take out 35 of that $40,000, go buy a really fancy car, maybe pay off some student debt, do whatever with that 35. They can do whatever they want with it. And then they pay it back over the 5 years. And then they take out another 35, pay it back over 5 years, and keep going that way. And we'll notice when we look at when they're 70, they've paid back all their loans. They have the exact same cash value, $1,262,000 and some change. Pretty cool.
Why does that matter?
Right.
Help us understand that.
Yeah, because they're not taking out their cash. They're being given the cash from the general fund of the life insurance company. So their cash continues to grow as if they didn't touch it. They lost no growth of their cash, both the guaranteed side and the dividends, because they've been using it over time, but it's not their money they're using it from the general fund. Now, here's what that looks like in graph form. Now, there's 2 lines here. There's a blue line and an orange line. It's hard to see the difference between the blue line and the orange line. The blue line is the cash value without the loan, and the orange one is with the loan. That's kind of the point. It's hard to see the difference because you're still getting the same growth. You're still able to take the same amount of income whether you touch the money or don't touch the money. And of course, touching the money, paying it back, of course. Now, this is what the same person looks like with kind of a complete picture, the exact same policy. So the top line, the gray line, is the death benefit. That's what you might think of first when you think of life insurance. It's the biggest, most beneficial part. But look at the orange line is the cash value. That's the same orange line that was on the previous slide. And then the blue line is the premiums paid cumulatively. Notice that that levels off, and the orange line, the cash value line, is higher than that blue line once we get a few years in. And then my favorite line, the yellow line, is when this person turns on passive income at age 70, just starts taking money out of the policy to go buy groceries, take vacations, do whatever they want with it. And you'll notice that the yellow line, they take out a same amount every single year, so it's nice and linear what they're taking out. That yellow line, when they get to age 95, look at that. They've taken out $1.5 million from this policy, even though they only paid in about $600,000. That'd be pretty good, right? To put $600,000 aside for your retirement and then be able to take out $1.5 million. But then look where the gray line is. Their family, if they got their wings at age 95, is still going to get a death benefit. There's still money there to cover final expenses, pay it forward to the next generation, all that kind of thing. That's pretty cool. I hope this is helpful to kind of see it laid out this way. I've got another graph that lays it out too. The blue line at the top, same cash value from the life insurance policy. You see it go up and then start coming down as you take out the income. The gray line is if you put that same $18,000 a year aside in savings, did not touch it, you got a nice 2% return every single year compounding, and you instead just used, like Amazon financing or something like that to buy your inventory, kind of do that on the side.
Okay, I'm sorry to interrupt. So you're showing us a tale of 2 different people.
Right.
One has just saving and a whole life policy with no loans. And we've already talked about how the loan grows whether you borrow or not. The cash grows whether you borrow it or not. The gray line there is if you just saved in a savings account.
Right.
Got it. Okay.
Yep. And then the orange line is if you're saving that same $18,000 in just a savings account, but then you take out that $35,000 and you use it to buy inventory and then pay it back to yourself. You notice that the savings at age 70 is way lower than the other 2 options.
I'm sorry to interrupt you again, Amanda, but so the orange line there, is that the one at the bottom?
Yeah.
I'm seeing. Okay, so that's someone who saves up and pays cash. That's the airplane with no tailwind, no headwind. They're just saving in a savings account for their inventory every year and paying cash.
Yep. And I made sure I used the same dollars going in, same dollars coming out on all three scenarios.
And this is showing us 0 means we're out of money. And that means if we were to spend that money in retirement out of that savings account, you'd run out at approximately what age?
Yeah, look at that. A little over 80 years old, maybe 81, 82. With that, if you're buying inventory with that same savings. If you actually use financing, you pay someone else some interest, your money lasts a little longer, 87, 88, somewhere around in there. But remember, with the life insurance, you've used all that till you're 95. There's still a death benefit left over. That's not even accounted for in this graph. That's kind of which plane would you get in? Which story would you want to tell? Which pile of marshmallows would you want to have at age 70? There's lots of different ways to look at this and say, okay, which financial vehicle would I want to use and why? So I hope that's helpful. I'm going to pass it back over to Mark because you'll notice that, sorry, I forgot. I'm supposed to do the slide too. If we zoomed in on that last slide and looked at the first few years, you would see that the savings and where we're just putting into a savings account, you're going to have more money at the beginning because you've got the cost of the insurance in those first few years. So that means you have to be willing to set aside some money and not touch, maybe touch it or maybe not use as much as you could if you were just paying cash or putting it in savings. So you lose some purchasing power in those first few years, but is it worth it if you're looking more over the long range like we're talking about here?
Mm-hmm. Awesome. Thank you for that. Thank you. Thanks, Amanda. So we're wrapping up here, but what is your business really good for? It's there to serve you, right? It's not the other way around. Your money should be the same. What if big changes come? No one knows what the future is going to hold. All it takes is one press release from Amazon for something to change in our businesses all over again. Right? So we have to think strategically about our life. If you can envision a time when your business condition is not as good as it is today, if your business might suffer there, if you could envision a time where maybe the possibility that a change in technology or regulations make the businesses that we all have and hold dear less profitable. Could competition possibly gobble us up? We don't need to discuss the percentage of businesses that fail every year or don't get passed successfully on to the next generation. We all know those statistics. Having all of your assets inside your business can create real long-term risk to you and your family. So I'm speaking directly to each of you guys now. This is a big deal. This is life or death for the Amazon business that you hold. In your overall financial plan, diversification of your assets are important. Let the business ride hard. I want you to push that business to its limits, but I want you to take some money off the table so that you can protect it if and when those headwinds come our direction. Okay? Most small businesses believe, I think, that their business is going to be their retirement plan. But unfortunately, very few people have a ready buyer to buy that business when you're ready to start taking income passively. So setting some money into one of these policies could be a successful alternative to diversify your portfolio, not just your business, but to have your money in other areas as well. All right. So plus, if you warehouse your profits, you can even lend it back to your business when you need it. So I do this all the time with my business. My policies are there as a line of credit guaranteed for my financial business that I own anytime, whether banks are lending or not. So when you think long range, you really think toward the success of your whole financial life, not just this month or this quarter or just how to sell things on Amazon. So I believe in you guys. I think you have the coolest business in the world. If I was not in this deep as a CFP, I'd be starting my Amazon business. Maybe I should anyway, all right? Because I learned so much from you guys in our one-on-one consultations. I've learned more vocabulary than I think I ever knew before. Acronyms abound in this group, RA, OA, it continues. So, but you want to think long range, and that's been our theme for the day today. I want to ask the focusing question of the conversation today. What's the one thing you can do with your money? If you could only do one thing with your money, what's the one thing you can do with your money such that by doing that, everything else would be easier or unnecessary? I feel that's a helpful question because, every door has a hinge. It's a small little hinge, but it swings a big door. I could put my money in a brokerage account, and maybe I'd get a higher rate of return or whatever, but does that do the one thing that would make everything else in my financial life easier or unnecessary? It's my opinion that once you have the right mindset, and that's key before you get started, having the right mindset to think like a banker, if you put a policy together for your business and for your family, everything else becomes easier or unnecessary. I'm no longer concerned about begging Amazon for a loan. It's unnecessary if I'm my own source of financing. I'm no longer chasing rate of return in my 401k. It's unnecessary. Paying for inventory is easier with one of these policies. So what's the one thing you could do with your money such that by doing it, everything else becomes either easier or unnecessary? That's the question I'd leave you with today. And if you're ready to get started asking that question for yourself, I don't know you personally. I know many of you, and it's been a pleasure to get to know you over the last few years, but I don't know many of you as it's your first time here too. Or maybe you've heard me for a year or two, and you're ready to take a first step. Let's find out how. In our one-on-one consults, what we do with folks is we look at least 8 ways to free up money in your business and on your personal side that you may have overlooked. And maybe it's a way to make things either more efficient or more effective. No two policies are alike, so the numbers we just showed you are not your numbers, obviously, but obviously we would design a custom designed solution for you if it's a good fit. And if you want to find out what your actual numbers look like, your bottom line, end of the day, here's the cost, here's the growth, here's how it would impact your business, give us a shout. Reach out to us today. We do a free, no obligation consultation. It's totally, just a privilege and opportunity for you guys as Amazon Legends members. So there are a lot of advisors out there. There's over 10,000 financial planners, I guess, in this country I found. But there's a lot of people who have read this on Google or stumbled across Bank on Yourself. Would be very cautious to set this up with just anybody. There's a lot of great things to be a specialist in, and we contend that we're trying to make this our specialty. We try to get better at this every single year. We're not, if you want to come to me and talk to me about options or hedge funds, I'd probably point you down the street. That's just not what we're specialists in. This is what we specialize in. You can end up, if you work with the wrong advisor, you can end up with the wrong insurance company or the wrong contract. You can get a loan feature that totally messes up your policy, or it could become taxable in retirement. We want to try to avoid those things if possible. So we want to ensure that you have a financially fit life insurance company that's going to be around for 100 years. I don't want your life insurance company eating that marshmallow either, right? So we need a financially strong insurance company to back you. And usually I don't recommend any insurance company that hasn't posted profits for at least 100 years straight. That's the kind of financial I'm looking for. Okay, and we are among only about 200 financial professionals in the country that have got the badge of honor as bank or self-authorized advisors. And that's where Danny and I originally met, was through Pamela Yellen's website. So we had to run through those, jump through those hoops as well. So here's the big ask, I guess, at the end, and we can take as much or as little time as you would like us to have, and we can, okay, good. So as you have availability, you have the folders on your tables. Grab the folders if you haven't already, and fill out your name and information at the top. If every single person could give us feedback, and we'd love to get your evaluation at the top of the sheet there. It's the golden sheet of paper. And there's a couple of questions at the top that we would love your feedback on. And if you'd like to have a further conversation with us, fill out the bottom half of the page as well so we can reach out to you. There's also, if you have a smartphone, you can also go to AmazonLegendsFinancing.com. AmazonLegendsFinancing.com. It's a special web page we've set up just for you guys where we do a free 15-minute consultation. Just 15 minutes. We can see if this is a good fit or answer any questions since we won't have time to do Q&A today. So if you guys have a few moments, we will be going around and picking those up here as we have our next session. And you can go ahead and do that now. Oh, yeah. And if you wouldn't mind, as you're filling those out, fold them, and we'll certainly collect them confidentially. Amanda will be coming around with a bag to collect those. thank you all. It's an honor. It's a privilege. Good luck in Q4. Thank you, guys.
Thank you, Mark. You guys, we are so very honored and grateful for Mark and his team to be here. We want to say a quick thank you. We have a thank you gift here that